Welcome to Investors Insights, where today's topic is market resistance. A lot to talk about today. Before I talk about what we're seeing with market resistance and before Ty talks about GDP, Trey, the Fed is meeting this week. Talk about that.
Yeah, thanks, Bob. The Federal Reserve, whenever they meet, the whole market stops. And even though, as you can see on this chart, what this chart shows the likelihood of a Fed rate cut, even though the likelihood of the Fed making any action is very small, it's getting an official update on the record of what the Fed thinks and what they project out, what their models are showing. Because even though the Fed just met in mid-March, a lot has happened since their last meeting. And so a lot of the data is backwards looking. So we get a live update of what the Federal Reserve is seeing, what they project, the dot plots of where they see interest rates going, because the next meeting you can see here, there's over a 70% chance of some sort of Fed action at their next meeting. So the Fed will likely want to start being transparent and trying to lead the market. You can see here, since the last Fed meeting, what's happened to the S&P 500, the 10-year Treasury yield, and the 2-year Treasury yield. And so the S&P on here is the purple line. You can see it took a large nosedive, but is pretty much back where it was the last Fed meeting. The 10-year Treasury did the exact opposite. It spiked up, and now it's back pretty much roughly where it was at the last Fed meeting. But what hasn't spiked back is the 2-year Treasury. You can see the interest rate on 2-year Treasury is 10% below where it was the last time the Fed met. Now, why is that important? The 2-year is the shorter end of interest rate curves, and that is the part of the market that is more dictated by expectations around Fed policy. So the market is saying they expect the Fed to start cutting. The rest has kind of recovered where they were, no action. But that part is telling us that the market expects it. So what will be very telling is how the Fed reacts to what the market is saying and how they react to what's happened over the last month or so. So very important meeting, a lot to come out of it.
Yeah, so obviously a lot of unknown with the trade talk and the economy. So hopefully the Fed will give us some clarity this week. And then we have been getting a lot of questions about if the market is out of the woods yet and if the volatility spike around the tariffs is over. So I want to give a quick update on that. One thing we look at in considering if market rallies are sustainable is by looking at where the S&P 500 is compared to its 250-day moving technical averages. So as you can see in this chart, the S&P 500 is the blue line, the 50-day moving average is the yellow line, and the important 200-day moving line is the red line there. So the S&P 500 has come back up recently, which is great, and it's getting close to the 50-day moving average. And so what we do is we look at this chart because the yellow and red lines are where the market needs to get past to confirm a rally. A lot of times, like it did in late March, as you can see in the chart there, the S&P 500 briefly went above the red line, but fell as it hit resistance. So it's very important over the next few weeks that the market goes above the yellow and red line and holds above them, which would be a good sign that the rally off the lows is sustainable. But so in summary, we're watching our indicators carefully to see if the rally off the lows can be sustained. So Ty, Trey talked about the Fed meeting this week. Last week, we got a revision and got an updated number on GDP. Talk about that number because it moved the markets.
Absolutely. So we got some numbers, initial numbers on real GDP for Q1, a decline of 0.3%. Expectation was a decline of 0.2%, so a little worse than expected. And, I know a lot of times the rule of thumb is you get two negative GDP, numbers in a row, and that is kind of defined as a recession. But obviously, it's never that simple to interpret. But why are we not saying be on red alert for recession right now? Because that 0.3% drag was almost entirely due to net exports. So we imported a lot more than we exported. That's because everyone was trying to front run tariffs. So a lot of imports came in, which is a detractor from the GDP number. And that was the biggest factor overall, contributing to that real GDP decline of negative 0.3%. To put it in perspective, the trade drag on GDP was the largest that has been in any quarter since 1947. So obviously a huge impact. But if you strip out, kind of that stuff and you kind of focus on what we call the core real GDP, which is consumer spending, business, fixed investment, home building, and things like that, exclude some of the more volatile categories like inventories and trade and government purchases, we were actually up 3%. So fairly strong number, kind of on pace with what we were last year. And so again, not a red alert for a recession. We certainly want to see how it plays out now that tariffs are more in place, even though, of course, that keeps going back and forth, but at least they're in place now, and I think the front running of the imports may start to decline, and we might get some truer GDP reports going forward.
Yeah, so a lot to look out for this week. We're watching to see if the rally can sustain itself off the lows. Then obviously what Trey talked about with the Fed. So a lot going on this week. If you have questions about anything we've discussed, please call us, email us. We love to hear from you. Have a great week. Thanks.